Welcome to the one that just joined also. My name is Daniela Crăciun. I'm Secretary General of CEE's Perspective, and I am very pleased to welcome you to today's webinar on Europe's capital market and the market integration and supervision package. Today's topic comes at a very important moment. For many years, Europe has spoken about the need for deeper, more integrated, and more competitive capital markets. The ambition is not new. What is new is the political urgency around it. The European economy needs more private investment. Companies need better access to financing. Citizens need more opportunities to put their savings to work. And in Central and Eastern Europe, where capital markets are still developing in many countries, these questions are especially relevant. The market integration and supervision package is one of the most significant proposals in this area in recent years. It raises practical questions about supervision, market infrastructure, post-trade rules, and passporting. But it also raises a larger political question. How much integration is Europe ready to accept in order to build capital markets that can truly operate at scale? This is why we wanted today's conversation to bring together complementary perspectives from institutions, market infrastructure, and industry. A warm thank you to Anna Grochevska from the European Commission, Gillian Leeson from Euronext, Claudio Vidal from Federation of European Security Exchanges, and Elena Toneto from the European Association of CCP Clearing Houses. And of course, thank you to Andrea Lungo, our policy expert, who will moderate today's discussion. For those joining us for the first time, CEE Perspective is an independent association focused on financial sector developments in Central and Eastern Europe. Through our academy, we aim to make European policy discussion more accessible, more connected to the region, and more useful for the people working in these issues in practice. If today's discussion is useful to you, I warmly invite you to follow CEE Perspective on LinkedIn and YouTube, visit our website, and subscribe to our newsletter, where we continue to share analysis, event updates, and recordings from our academy activities. We will dedicate our time at the end of the discussion to our audience. I would like to encourage you to put forward your questions for our panelists. We would love to hear your concerns or doubts. With that, I will hand over to Andrea, and I wish you a very interesting and productive discussion. Thank you.
Thank you very much, Daniela, for the introductory remarks, and thank you everyone for joining us today for this webinar on a very important topic within the financial services area. So my name is Andrea Lungu, and I am a policy expert at the CEE Perspective. It's my pleasure to moderate today's discussion on the market integration and supervision package. So MISP is one of the most important financial services initiatives currently under discussion in Brussels, and one of the key pillars of the Savings and Investment Union. So at the core, there is a simple question: how can Europe build deeper, more competitive, and more integrated capital markets? However, while there is broad agreement on the objective, there is much less agreement on how to achieve it. Because precisely the debate touches on various aspects, notably market integration, supervisory convergence, competitiveness, as well as the balance between European and national supervision. And one important dimension is how it touches upon the Central and Eastern European region, and what the benefits of integration could be for markets of different sizes and levels of development. So it is my pleasure to be joined by an excellent panel today. The structure of the session today will be, we will have a first round looking at why MISP was proposed and what challenges it seeks to address. Then we will move on to one of the most debated elements of the package, notably the ESMA governance and supervisory convergence. And finally, we discuss the way in which these reforms, what they mean for smaller markets, including those of Central and Eastern Europe. So let us begin. with the most fundamental question: why MISP and why now? So Anna, perhaps I can start with the question for you. So from the Commission's perspective, where do the costs of fragmentation arise most acutely today? And how would MISP address those barriers while also ensuring that greater integration benefits markets of all sizes across the EU? So Anna, you have the floor.
Many thanks, Daniela, Andrea, for the invitation. My pleasure to be here and speak about MISP, our flagship proposal, to precisely address the remaining fragmentation of EU capital markets. So as we know, the barriers to capital market integration have been, there were attempts to address them for years, but despite efforts, some barriers remain, and our markets are far from being fully competitive, fully integrated, and fully efficient. It's a vast topic, so let me maybe just give a few examples. I will focus on the trading space because that's where my department is in charge. So let's start from the level of end investors. Here, one type of fragmentation we can notice is the fragmentation of pre-trade information available. So we indeed almost have, it has been designed and it will soon become operations. We have an EU consolidated tape, so-called, but its design is suboptimal. It only contains one layer of bid and offer prices. It does not contain attribution to the venue where these prices are available. So it's a weakness, and this is what MISP is trying to address. And now turning to financial market infrastructures, because there also we witness quite many barriers. One barrier is the fact that several member states set specific requirements for operations or authorizations of financial market players, and this obviously impedes crossover operations. It requires setting up entities in various member states, even if maybe it would not be strictly necessary. So this is what MISP tries to address as well, to harmonize authorization processes, to harmonize also the rules which determine the operations of regulated markets. And maybe one final barrier, also linked to the operations of financial market infrastructures, the open access issue. So in theory, we have some open access arrangements which would allow CCPs, CSDs to access trading venues, so we would have some competition for the provision of this kind of services. In practice, it does not work well. So these processes to access venues take lots of time, and that's another topic we try to address in MISP. Thanks.
Thank you very much, Anna, for the insightful remarks on the specific barriers and how the Commission is planning to mitigate them through the package. Now, if I can perhaps move to Gillian. So Euronext has consistently argued that greater market integration is necessary if Europe is to mobilize investment, support growth, and compete more effectively on a global scale. So from your perspective, what does success look like in 5 years' time if MISP works as intended? And what are the biggest obstacles standing in the way today?
Thanks, Andrea, and thanks to CEE Perspective for inviting me. Delighted to discuss the hot topic of today on the MISP package. So, I mean, to your question, what should European capital markets look like in 5 years' time? I think, I mean, we've already touched upon it. At the core of the proposals, SIU ambition in general, it's the critical concept that Europe must channel its private savings into productive investment better and increase our attractiveness of our markets. The current fragmentation, such as regulatory divergence, limited cross-border scale, it continues to act as barriers to this growth. And the result is we see this persistent gap between Europe's economic potential and its actual performance. So for us, what does success look like? We would want to see a market in 5 years' time that's transparent and accessible to all, with efficient price discovery and fairness and trust, so that investors have confidence and companies are enabled to achieve optimal valuations. We want to see a market that's liquid, where capital flows seamlessly across the borders, And the liquidity reduces the cost of capital for the companies, it enhances the return for investors, and it enables efficient allocation of resources. This should make it easier for companies to access the capital and offer a more diverse investment opportunity across borders. But we'd also highlight we want the market to be resilient, so capable of withstanding shocks, adapting to change, given the turbulent times that we're living in today. So, I mean, all of this contributes to more competitive markets, which I think is everybody's aim. This requires robust infrastructure, effective and streamlined supervision, and reduced post-trade fragmentation, which I think the MISP package covers all of these, really, really key topics. At a high level, in terms of the supervisory framework, we're going to touch upon this in the next question, but I mean, we certainly see this as a prerequisite for deeper integration. We welcome the ambition from the Commission to deliver more effective and efficient supervision. It'll be a more harmonised and fair approach because there is a clear need to address that fragmentation. We also believe the changes on the post-trade side, will definitely help support competition and enable integration. We see, that the current situation creates significant barriers to cross-border settlement. The proposals that are there, we already have that common platform in terms of T2S. So, we really support that proposal to connect to T2S, and we actually think it should go a little step further to sort of ensure actual use of T2S, because we feel this is a functionality that should be enhanced and will help in terms of cross-border trading and post-trade. There's one other area I just want to touch upon also, which hasn't featured as much in the Commission proposals, which is in relation to market structure, because we certainly see this as an important foundation of the MISP package, and it's really essential in terms of effective capital raising, because we do need deeper capital markets, and the liquidity that is the key point, and that needs to be visible and accessible, because it's a key driver of the attractiveness of markets, and for both the investor and for the companies that want to raise finance. So we see there is a need to sort of rebalance the regulatory framework in order to achieve this. So, I mean, we've seen ESMA published a call for evidence there in recent times, which demonstrated that there is an increasing trend in equity markets towards certain bilateral type of trading, which is less transparent. And much of this trading is done the likes of midpoint, which has consequences for overall market functioning. This impacts the price formation and the visible liquidity, and it impairs the ability to give meaningful valuations. So we see this direct impact on primary markets and companies' financing. I know some have referenced the likes of the CT, but from our perspective, the CT is coming. It'll be here towards the end of this year, but it won't actually address these particular issues that we are focusing in on, because it'll only make transparent what's already actually transparent. So we feel that further changes on the CT shouldn't be made at this point in time, but instead we need to focus on actual market structure and making more liquidity transparent in the first place. So to do this, we have a number of proposals, because there are kind of certain lenient requirements applicable to the bilateral venues. So we suggest systematic internalizers should be subject to more equivalent type of requirements around publishing rule books, providing meaningful price improvement, and also enhancing the post-trade transparency so that more information is available to investors and to the market in general. We also believe that there should be a uniform application of the tick size. So these are all sort of areas that we feel haven't yet been incorporated into the actual MISP proposal, but we feel it is essential to have this as part of the debate too. So, we very much welcome, there has been recent discussion around this, particularly in the E6 letter that was published. And also we saw Ferber's report on the Parliament side, which has just come out, which has addressed some of these points. So I think overall, there's a lot to tackle within the MISP package, but I think it provides a huge amount of potential opportunities for the EU. Thanks.
Thank you very much, Gillian, for your insightful remarks. Now, perhaps I can turn to Claudio. So, FESE has often argued that deeper capital markets require more than supervisory reform alone. So, in your view, is Europe paying enough attention to market structure, liquidity, and competitiveness, or has the debate become too focused on supervision? Claudio?
Thank you, Andrea, for the questions and also to see perspectives for the invitation. It's a pleasure to be here and good afternoon, everyone. I mean, when looking at the bigger picture overall, I think Europe is focusing on the right problem, which is competitiveness. So the important thing is that the Savings and Investment Union strategy has clearly put capital markets back at the center of the policy agenda, particularly by focusing on how to mobilize retail savings, whether through the savings and investment account recommendation or the pension reforms that actually are currently under discussion, or broader initiatives aimed at improving access to capital. I think the Commission should prepare something in the second half of this year. So within this broader SIU framework, the MISP piece is a key piece. It touches on a wide range of legislative files, and what we believe is that it's critical to make the most of this opportunity to really reduce fragmentation and to improve how equity markets actually function in practice. But to your question, whether should policymakers be paying as much attention to liquidity, market structure, and competitiveness as they do to supervision, the answer is clearly yes, because what, in my view, will ultimately determine whether European capital markets are truly competitive is not only how efficient supervision is, but notably whether markets deliver sufficient liquidity, strong investor participation, and a transparent market structure that actually supports high-quality price formation and also encourages companies to list. And all these elements are very much interconnected. So, for instance, strong liquidity then supports reliable price formation. Reliable price formation builds investor confidence and efficiency in the market. That confidence and the deep liquidity, it's an important factor to attract companies to list. That in turn reinforces liquidity demand. We are talking about a really virtuous cycle. And this is particularly important across Europe, but also, and to the topic of today, the CEE markets, where triggering this positive chain is critical not only for the development of their own capital markets, but also for their broader real economy. And this includes definitely its companies, but also, I would say, normal investors like me and all of us. So now, if we also compare Europe globally, for example, with the US or Hong Kong, I mean, it's clear that we are still underperforming under a number of key metrics. But the positive point is that now we are observing that there is an increasing recognition of these challenges, including among policymakers, both in the Council and in the Parliament. So there seems to be a growing awareness of the need to use the MISP to really improve how our secondary markets function, and also to address existing gaps. So to conclude, I would say that the direction of the MISP is right, but the focus needs to be broader. Supervision is important and should be efficient and consistent, but competitiveness, and I am talking specifically from the trading layer, will ultimately depend on whether we can reduce fragmentation in liquidity, also deepening it and improve transparency and data quality, very important, where currently is lacking. So in order to make public markets more attractive, both for investors and for issuers, very important.
Thank you very much, Claudio. And the message is clear here. Perhaps I can now turn to Elena to finish this round of questions. So Elena, much of the debate tends to focus on trading venues and supervision, but post-trade infrastructure is equally important for market integration. So from the perspective of the CCPs, where do you see the biggest remaining barriers to a more efficient capital market, and how can MISP help address them? Elena, you have the floor.
Yes. Thank you so much. Thank you, Andrea, for indeed inviting me to this panel and to bring also the clearing perspective. As you said, there is a lot of focus on trading, also on CSDs, then on CASPs, but yes, there are also CCPs that are a fundamental part of market infrastructure. And also thank you to the Commission for putting out the MISP package. As a first comment, I would like to say, as many of you know, MISP is also reopening EMIR, that is the main regulation that sustains CCPs. And EMIR, especially EMIR 3, was actually closed very recently in 2024. And it brought a lot of benefits to make clearing more efficient and more attractive, the European clearing more efficient and more attractive. For instance, now we have a shorter time to market thanks to more streamlined approval procedures for new products and services that CCPs and clearing houses can launch into the market. However, as you have pointed out, there are still some barriers that, in our opinion, could be addressed to make clearing in Europe, in the EU, more attractive. And in particular, I would like to highlight three. One is DLT tokenization, then it's the access to clearing, and finally, transaction reporting. The first one, we have noticed that in the MISP, there are no specific proposals regarding DLT that concern CCPs. There are proposals as regard settlement and CSDs, but there is nothing really that supports the use of DLT and also tokenized assets for CCPs. And that's an element, an aspect that we would really appreciate if it could be included into the legislation, because it really feeds into the MISP narrative, let's say, of making Europe more attractive, also maybe more technologically neutral for certain aspects. So, for instance, the use of e-money tokens. We've noticed in the MISP that there are some changes that allow CSDs to use e-money tokens for settlement, but nothing for CCPs. So we wonder why? Why not? That could be something that also makes us more attractive. So CCPs can also use money tokens. Why not? Or another aspect, the acceptance of DLT-based financial instruments as collateral. So EMIR's collateral regime is robust. We all know that. And it's also technologically neutral. So CCPs should be able to accept tokenized and DLT financial instruments that meet the EMIR requirements. But again, this is not something that was reflected into the MISP. Perhaps it was just a bit left out, forgotten, or maybe it was not considered as essential. But it would really be great if we could see this in the final text. Another point that I mentioned is access to clearing. So especially the funds sectoral legislation still disincentivizes central clearing with respect to the counterparty limits for funds for certainly cleared repos. So this is a little bit maybe more technical for those who are listening, but just basically the money market funds regulation, as an example, does not allow funds to reuse or raise margins on CCP repo markets, keeping the cost of clearing higher than necessary, and also keeping the funds then trapped in the bilateral markets. And we are proposing some amendments to the money market funds regulation and some of the UCITS directive that could actually lower these barriers and allow a better access to clearing from funds, which is something that I understand has been called also from the funds industry. And the last point is streamlining financial transaction reporting. And that's something that perhaps also Claudio may understand. At the moment, we notice that there are different reporting standards, reporting requirements. So often CCPs need to report the same information to different authorities according to different templates. It would be great to streamline this and have, as proposed in the legislation, a database where the information is included and then it is shared with the relevant authorities. At the moment, I understand that in the Commission proposal, this is about supervisory reporting, this database, but we would really appreciate to see something also concerning financial transaction reporting, because this would facilitate everybody's life, not only CCPs, but also authorities' life. And this is something that we have noticed has been included into the draft report on the master regulation. So we think this is also something we can work on to really simplify, streamline, making everyone's life easier. Thank you.
Thank you very much, Elena, for your remarks. What is striking to me from this first round is that there appears to be, let's say, broad agreement on the destination, more integrated, more competitive, and more attractive European capital markets. Where views begin to diverge is on how the institutional architecture, or what type of institutional architecture is needed to achieve that objective. So one of the most politically sensitive elements of MISP concerns the future role of ESMA and the broader question of supervisory convergence. So Anna, I will come back to you now with a question. Why is stronger ESMA involvement necessary to achieve a more integrated capital market? And how can the package preserve an effective role for national authorities?
Thanks a lot, Andrea, for this question. So we now indeed turn to the hotly debated issue of central supervision. Actually, this diverging supervisory practices, it's another very important manifestation of market fragmentation. I did not mention it before because I knew we will be discussing this separately, but we face a lot of divergence. National supervisors interpret rules in different ways. There are, various understandings of several concepts: tick size, trading venue, parameters. So it results in a fragmentation. Of course, one possibility to fix it would be further rules, further guidance, level 2, level 3. But I guess this is not the right path. It would go against simplification, against burden reduction. And of course, regulation can never account for new market specificities, which could result in new situations. So I think this will not solve the issue. So what we propose instead is this rather ambitious idea of centralizing supervision for significant venues. So this means that we create a kind of synchronized single mindset, single interpretation of rules. So we don't have these variations across member states. We have single enforcement and interpretation of rules. And we think it really would change the supervisory outcomes. It's superior. It would be a by far superior supervisory outcome. But I think you also referred in your question to national authorities, because indeed ESMA would not do all the work on its own. It would focus rather on organizational requirements, while of course national authorities, which would now be called surveillance authorities, would have tasks which require the knowledge of local markets, also geographical proximity. So they would be involved in market surveillance. They would be involved in enforcing trading suspensions if needed, or removing certain instruments from trading. They would still be involved in, admitting new issuance into markets or prospectuses. So this would remain at national level. So we think we quite clearly delineate the tasks, and overall we believe this design could work out and, as I just said, improve the situation. Thanks.
Thank you very much, Anna. Claudio, perhaps I can turn to you now. So my question for you is, has the debate become too focused on supervision, and how should policymakers balance stronger ESMA powers with broader challenges that we mentioned regarding competitiveness, liquidity, and so on?
Yeah, honestly, I wouldn't say that the debate is too focused on supervision. I mean, supervision clearly needs to be part of the discussion, but it is sometimes treated as if it were the main solution, when in reality, I see it as one part of a broader puzzle, so not the silver bullet. So the real question is not whether supervision matters. I mean, it clearly does. One questions that, but the real question is how to design the framework or what to change so that it actually supports better and more harmonized market outcomes, and what would actually make it more efficient. On your questions on how to balance stronger ESMA powers with the broader challenges we previously alluded to, I do not think these are mutually exclusive. The discussions around liquidity, listings, and how the market function, and that of supervision are complementary and need to be pursued together. And talking about ESMA, I think one general comment I would like to make is that ESMA, in the end, is much more than supervision alone. It's also regulation, it's monitoring, it's analysis. Their expertise is very much welcome, even already today. And there is one very recent example that also Gillian has alluded to in her previous remarks, which is this ESMA call for evidence on equity market structure, which actually, through their expertise, they are already trying to help build a clearer understanding of how equity markets are evolving and where intervention may be needed. And here I would really like to just highlight one key trend, which is that these preliminary analysis that they have done point towards that there is a structural trend towards towards bilateral activity, or let's say accessible execution mechanisms that are maybe taking some liquidity away from lead multilateral venues, and in parallel also an increasing reliance on the reference prices that are generated by exchanges. And this raises important questions about the potential deterioration of the quality of price formation, transparency, the attractiveness that we have previously alluded to, particularly if there is no corrective action to really address these ongoing trends. So these are not new concerns. These trends have been highlighted by exchanges already for some time, but now they are increasingly being supported by additional evidence, which is great. So from our perspective, the priority should be to ensure that the ongoing reforms, including under the MISP, really address these underlying issues. That means more transparency, better data quality in the bilateral and dark space, ensuring a level playing field across execution models, and also reinforcing the conditions for robust price formation. But now back to the other component of your question, so supervision. And as I was saying, the supervisory framework itself needs to be carefully designed. So regardless of the ultimate model that is decided, there are certain guiding principles which we believe that should guide all reform. This is the clarity in the allocation of responsibilities, then avoiding duplication between ESMA and NCAs, and also ensuring that supervision is effective and efficient, and also that there is not like a duplication in the end of fees, because otherwise the risk is that we may be creating more complexity rather than reducing it. So the objectives are not in conflict. You can have a stronger supervisory convergence and stronger market outcomes, but only if they are designed together and with a clear focus, and it is important, on what we want European markets to deliver. And since you also referred to listings, I would like to end with one final point, which is access to finance. And public capital markets play a key role in that. Policymakers have taken important steps, for example, through the Listing Act, but we feel that more needs to be done, not only in MISP, but also beyond. So in order to really encourage a thriving EU listing ecosystem. So that, again, should be part of this key policy objective and this vision of the European equity markets that we want to deliver.
Thank you very much, Claudio. Elena, perhaps now a question to you. So in your perspective, where can greater harmonization genuinely improve market integration? And where do you see a risk of unnecessary complexity and duplication?
Thank you, Andrea. Actually, I would like to echo part of what Claudio just said. Actually, I think he stole my words when it comes to supervision, because I think this is actually the area in which we have, at least from the CCP perspective, the biggest risk of ending up with a system that is actually worse than the one that we have now. Because the one that we have now can be improved. Again, as I said, we have better time to market and more defined timelines for authorities to inform CCPs about their opinion or their decisions. But then we are hearing that the co-legislators are putting on the table several potential ideas about supervision, because CCPs actually support the Commission proposal of having significant CCPs under ESMA supervision, direct ESMA supervision, and less significant, more local CCPs under national supervision, but with a tweak, because we would like to see a removal of the colleges also for the smaller, less significant CCPs. At the moment, CCPs, less significant CCPs, also need to have the colleges consulted when there are the approval procedures in place. But we understand from our members that actually this is often sort of a formality, a step that needs to be undertaken, but then there is not really meaningful input. So in the spirit of streamlining and simplifying, we would see merit in removing this additional step of consulting the colleges. But besides that, we actually support the Commission proposal. But we indeed, as I said before, we are hearing potential ideas being put on the table, like joint supervisory teams, single, the SSM, like in the banking sector, or enhanced colleges even. But well, CCPs are not banks, so we should be careful with making comparisons with the banking sector. And also, if we have a double supervisory system with ESMA and NCAs deciding, but then who is the ultimate responsible? Who is the one making the final decision? This is why we would like to see clarity. We would like to see clear responsibilities and having one authorities that at the end makes a decision, because otherwise the good time to market that we have now will be worsened, and the system that we have now will end up being better than the one we may have with MISP. So why proposing a new supervisory system at all if we want to end up worse than we are now? You understand? And so I think this is the area where we see the highest risk of having duplications, complications, different authorities having the same, let's say, power in decision making, while we would like clear responsibility, clear tasks, and at the end, one that decides.
That's very clear. Thank you very much, Elena. Now, finally, turning to Gillian. So one of the assumptions underpinning MISP is that stronger supervisory convergence can facilitate market integration. So from your perspective, is that assumption correct? And where do you see the greatest opportunities and risks for market participants?
Thanks, Andrea. Yes, so I mean, in Euronext, we certainly believe stronger supervisory convergence will help drive integration. But I guess just to mention, it's not just supervisory convergence, because I think, supervisory convergence has been around a long time, as a key objective, and feel we haven't really got there with, with what has been the case for the last sort of 10, 15 years. So that's why we think those bolder steps to move to central supervision really is important, for the most significant and the cross-border FMIs. We feel this is definitely essential. The current supervisory framework, I think, again, I'm going to echo potentially some of the other speakers, but it just doesn't support scaling up currently, in terms of trying to operate across borders. The current framework just doesn't work. Dealing with numerous NCAs, the different requirements, the different interpretations, it's incredibly challenging. At Euronext, we now operate 8 regulated markets across Europe. We have 5 CSDs, we have 2 clearinghouses. So we live these challenges and difficulties every day, and we have tried to build efficiencies where we can. We set up sort of an informal college of regulator on the exchange side, but it still doesn't address the fundamental issues of the different views and the gold plating and just the different approaches. So we think there's definitely this, a clear need for this efficient and more streamlined supervisory framework, because that's the only way that you'll be able to fully support integration across the markets. So we are very hopeful that the central supervision proposals will deliver this. in terms of what's in there, in terms of the actual package, you know, the proposal around the pan-European market operator, the new PIMA regime, where there's one single authorization under central supervision. There's also then the ability that regulated markets will be able to operate branches across the EU under one license. So we see these definitely as very positive developments. They'll allow groups of exchanges, you know, like Euronext, to optimize their operations and to benefit from the synergies. And this should lead to deeper integration across the EU. And we also agree with the idea, you know, that including significant FMIs across the board under central supervision is essential, so that there is that level playing field, because in our view, FMIs that are all of similar size, similar scope, should be subject to the same supervisory framework. I also just wanted to call out, and I think Elena touched upon this as well, another positive proposal in relation to the central reporting database, because, you know, I think at the start it didn't get as much focus. But when we saw that, we felt that definitely is going to improve efficiencies. But we fully agree with the previous points made that, you know, we think this should be leveraged for regulatory data reporting to streamline. I mean, I know ESMA has been looking at this too, but you know, this could be used for that sort of follow through on the ambitions of, you know, report only once principle. So we feel this could definitely be built upon. And then, of course, all of these proposals clearly need changes made within ESMA. So I think, you know, the ESMA governments, the reforms that are being proposed there are very helpful and very practical. So we definitely support the creation of the new executive board. We feel it's important that the final structure that's sort of agreed upon ensures that there's going to be faster, more predictable supervisory outcomes. One of the biggest risks, that's part of the question that you asked me, again, it's going to be similar to what some of the others have alluded to, and we certainly see the biggest risk of the proposals is this division between the competences between local NCAs and ESMA, and also the potential related fees that could be charged as a result of this. So we, you know, as I said, we're strong advocates for the idea of central supervision, but we definitely don't want to end up with a regime that potentially duplicates or actually creates more inefficiencies and costs. So, you know, we don't want to have sort of an additional layer of complexity or, you know, long transition periods that actually end up entrenching sort of complex structures such as College of Regulators and joint supervisory teams. So we have seen on the council side, you know, there obviously have been lots of different discussions. You know, we're slightly worried at some of the directions these may be taken. I mean, we do understand, obviously, there are political sensitivities around this, but we certainly urge member states to really sort of see the bigger picture and see the longer term vision, that we don't want to end up with something more complicated than what we have now. From our own perspective, you know, we want to see a clear allocation of responsibility between the central supervisor, such as ESMA, and the, you know, the actual NCAs that are responsible for the local market surveillance. We feel the legislative provisions could reflect this more clearly and be more distinct, you know, so that when NCAs need to receive information from entities under ESMA supervision, this is explicitly limited to their role in terms of market surveillance. But the actual supervisory responsibility still must rest sort of exclusively with ESMA, so that we have kind of one supervisor per entity. This then just brings me on to the topic of fees. You know, again, it should be clarified that the local NCA or NSA, if we're talking about them on the market surveillance side, they can't or shouldn't be able to charge, you know, additional supervisory fees for activities that they're just not supervising anymore. So we do see a risk there that potentially there could be dual fees charged. So I mean, we really feel for the surveillance tasks, you know, NSAs should charge, you know, all market participants in the relevant jurisdiction, but it must be in a proportionate manner, you know, and there should be some kind of EU-wide benchmarking to ensure that, you know, this is kept sort of practical and minimised. I think on the Parliament side, some of us have made reference to this. We saw in Ferber's report, you know, it's just come out, and he certainly has highlighted some of these risks very well and has proposed some very sensible, practical amendments. You know, so we're hopeful that this will ensure that there would be, you know, definitely an efficient and effective regime, while ensuring ESMA, you know, will be ready to take on the new role. I think he also includes an interesting suggestion, you know, around secondment programs for NCAs, so that they'd still, you know, need to be involved. You know, we're going to look at that further. You know, I think it's an interesting point to consider. So I think overall, in terms of the supervisory structure, you know, we want it to be robust. We want it to be credible and streamlined, and definitely sort of the new framework needs to be aligned with the new realities of cross-border markets.
Thank you very much, Gillian. Now moving on, let's say to a different aspect of the conversation. So European capital markets do not all start from the same position. So the opportunities and challenges created by deeper integration may not be felt equally across the Union. So for Central and Eastern Europe, this debate is particularly important. Why? Because many markets in the region remain smaller, less liquid, and more reliant on bank financing than larger Western European financial centers. So I would like to conclude our substantive discussion with a question focused specifically on the regional dimension of MISP. So in this respect, what would success look like for smaller markets, including those of Central and Eastern Europe? And what is the biggest risk that deeper integration unintentionally reinforces concentration in Europe's largest financial centers rather than strengthening the single market as a whole? Elena, perhaps I can start with you, if that's fine.
Sure, thank you.
Yes.
That's actually a conversation that we had also within the association. So where is the risk for a smaller player in MISP? And here I would like to reconnect to something that was mentioned before. And in our opinion, from the CCP perspective, could be the fees, supervisory fees. Because if, as we discussed before, the supervisory structure is not well defined with clear responsibilities and tasks, and we have a duplicative supervisory system with two authorities, ESMA and the NCA, deciding potentially there could be double fees. And we understand that for smaller, so-called less significant CCPs that serve a more local market, this could be financially very, very burdensome, even potentially driving them out of business. And it would really be a pity if integration then was getting rid of smaller CCPs that are working and are authorized by EMIR just for a fees cost. So that's, I think, where we see the biggest danger from the CCP side. Thank you.
Thank you very much. Gillian, perhaps I will give the floor to you now.
Sure, thanks, Andrea. Yeah, so I mean, for me, I think it's sort of in the name in terms of market integration package. So, you know, the aim is to integrate all markets, you know, so the whole European market can benefit. We want the EU as a bloc to sort of to increase the attractiveness and competitiveness. So, you know, we see all of these proposals which, you know, aim to increase liquidity, ensure fair competition, stimulate investment, etc. As, you know, they're all crucial parts of SIU. And integrating markets is a central element of that, so that companies can raise finance, get access to the investors they want wherever they may be. So, you know, we are hopeful that, you know, it won't be a case that some, you know, smaller markets will somehow not benefit, you know, in the same way. I mean, I do understand, you know, the concerns. You know, obviously all markets want to make sure their voices are heard. And of course, all the markets matter. And I mean, I think within Euronext, in a way, we're like a mini example of, you know, integrating markets already, because, you know, as I said, we operate 8 regulated markets. Some are very large markets, but we have some that are a lot smaller. You know, we operate a federal model, you know, so we see the huge value on the proximity to the local financial ecosystem, but we can combine this with leveraging it on a European scale. So, you know, we use the same trading system, but we still focus on the local aspects. You know, we work with the local market participants. This is an important part of this, providing the investors via local brokers with access to a wide range of trading opportunities, etc. So, I mean, I'm based in Dublin, and I've actually been here for 20 years. So I've seen firsthand, I guess, the benefits, you know, of integration. And, you know, when we joined the Euronext Group back in 2018, our trading firm numbers doubled. And we definitely saw a lot more liquidity being brought to the stocks in our market. So we see the MISP package as an opportunity for all markets, you know. And I think some of the less discussed proposals will also help. You know, for example, it's going to be easier for brokers to connect to more markets. So that again should help bring liquidity, across the board. It'll bring more visibility for local issuers, etc. So I think overall, I guess I go back to the first comments I made on the success of MISP, because I don't see that being different to some of the smaller markets. We see integrating the fragmented markets and improving the general scaling opportunities, and reducing the barriers. It should benefit everyone. And then I think the last comment, I suppose I just wanted to as a reminder, there obviously are lots of other initiatives that are being progressed, that are all kind of necessary for SIU in general to succeed. So we've already mentioned, so there's obviously the remaining elements of the Listing Act. There's the recommendations on the savings and investment accounts, the work on the financial literacy. So, the Commission is doing a lot, I think. All the work that's being done on pensions. So they're all, critical to stimulate investment, make the markets more attractive and competitive. But I think that this MISP package is certainly a central element that will hopefully benefit all markets.
Thank you very much. Maybe I'll now turn to Claudio and then Anna to finish off this round of questions.
Yeah, thank you, Andrea. I believe that integration can deliver equally if it's designed with that objective in mind. But I also think that success should not be measured only by scale or centralization. In my opinion, and from a CEE perspective, success would mean that integration and all these reforms that we have been discussing actually also strengthen their local ecosystems, because regional and local markets also play a fundamental role. They finance SMEs, they support innovation, they connect their markets with the real economy. So they also help build domestic investor bases and a long-term investment culture in their communities. And stock exchanges at the heart of this local ecosystem often even perform a function which could be described in many aspects as societal even. So success should mean stronger retail participation, deeper domestic investor base, more SMEs accessing public markets, more liquidity across all markets, not just the largest ones. And all this is not about protecting local ecosystems, but more about giving them the right tools and conditions to grow and to contribute to the overall strength of European capital markets. So the key principle is proportionality and inclusiveness. But we do need to include smaller member states and the CEE region in particular in this whole project, if what we really want is to deliver a truly integrated and competitive European capital markets.
Thank you. Anna, turning to you now.
Thanks, Andrea. Thanks for this indeed very relevant question. I think indeed it's an important one. We need to convince also the member states with a bit less developed financial ecosystems to buy into this project. So actually my answer will be quite simple here and quite aligned with what other speakers said. So first of all, the MISP proposal is for all member states. We believe each and every member state will benefit, because MISP allows them to access a bigger pool of liquidity, bigger market. So by definition, the companies get better financing, better terms of funding their investments. But okay, now let's be a bit more specific. So indeed, there are some concerns in some member states. I think some have been addressed here, fees. One other concern is consolidation, market consolidation. So here, maybe to dispel this myth, the package by no means forces any consolidation in the market. It's true that it removes some barriers, so it allows companies to operate maybe easier cross-border, but this is, I guess, what we want for every market. This is the market reality. We want companies to exploit economies of scale to become more efficient. So I think this can, again, help everyone. Then there is potentially a concern about small markets being served in such a situation of integration. Indeed, some smaller infrastructure maybe will face competition. But this, again, we do not believe is a real concern. On the contrary, easier cross-border operations for groups will make it easier, cheaper to serve smaller or remote markets. So again, we believe it plays to the advantage of small markets. And maybe before closing, Andrea, you mentioned indeed rightly the different positions as regards capital market development. So from this perspective, actually, we believe MISP benefits most these underdeveloped countries because their markets are underdeveloped. So maybe access to funding is more problematic, more expensive. So if they can join the bigger pool, I'm truly convinced they can benefit most from this idea.
Thank you very much, Anna, and everyone for the very valuable and insightful contributions. Perhaps now we can take a couple of questions from the audience, and we received a couple of interesting questions that I will take the liberty to rephrase. Regarding ESMA supervision, we received the question on the practical implications of stronger supervision. So, for example, if ESMA were to take on a larger supervisory role, what would this mean in practice for day-to-day supervision? And would responsibilities such as licensing, governance arrangements, and like regulatory reporting also need to shift? And has sufficient thought been given to the operational changes that this would require? I don't know if anyone would have some initial considerations on this.
Well, perhaps maybe I can just kick it off. I mean, in terms of the actual, obviously I'll defer to Anna on the actual Commission proposal. So, I mean, it does set out the different operational, areas, I guess. I mean, from our perspective, we want ESMA to be responsible. If ESMA is responsible for an entity, it should be responsible for everything. I think the question around the data reporting is certainly an interesting one, and that is where I think in the actual sort of proposal that sort of indicates that actually local NCAs would still be receiving the data reporting, and that's where we think there maybe needs to be a little bit of a discussion around that, and to kind of work out, could we have some kind of central hub that, if entities report data reporting, that it should just go to one central hub, and then all NCAs should be able to sort of to get that information via that hub, rather than having, again, different channels, different data reporting going in different ways. But I think, it's certainly something that I understand is being discussed in more detail on the actual operational aspects, but that's where we want there to be certainly a clear division of responsibility, and that ESMA is responsible for the actual tasks.
Thank you very much. Then we have, yes, Anna, please.
Well, I just wanted to add on these questions. Of course, the change in the supervisory setup requires some adjustments in the organization of supervision. To me, these are more technical considerations. Of course, it's important to prevent any duplication, to keep fees under control. So all this will be catered for. We want to design it very, very well and in an optimal way, of course. But we believe, first, we believe it can be done, but it's more a secondary issue. So I think first one has to agree on the principle and then work out the exact attribution of roles.
Thank you very much. Then we already touched upon this, but we got a couple of questions on the implications of the package for smaller markets. And here again, I am rephrasing a little bit. So again, given the significant differences in size and development across EU capital markets, how can stronger supervisory convergence support integration while remaining sensitive to local market conditions? And how can policymakers ensure that smaller and developing markets, such as the ones of CEE countries, are basically not left behind and that they benefit from the reforms of this package. I don't know if anyone would have some preliminary thoughts on this.
Maybe I can just comment very briefly is that I think overall we also need to recognize that there is not a one single model in Europe more broadly, and therefore all the policy and regulatory reforms need to also acknowledge the diversity in the business model, the different realities that we have in the market, and really try to adapt or to contemplate that. It's a very difficult exercise. Definitely, sometimes I won't like to be on the shoes of Anna in that point, because we need to condense that in the text. But I think it's important to bear in mind that not the EU markets are not the same, and we need to consider how they operate differently, what is the reality and the local ecosystem, not to hamper it.
Thank you, Claudio. And one more question to perhaps close of the session, and this would be for Julian. So, Euronext's federal model is often cited as an example for successful market integration. Do you believe that it offers a blueprint for how Europe can achieve greater capital market integration while preserving the diversity of national markets?
Thanks, Andrea. Yeah, I mean, the Euronext federal model certainly it looks at both sides, because, as I said before, it sort of leverages the scaling abilities of a larger infrastructure while still focusing on the local ecosystems within each market. I mean, but I think certainly it can be looked at in terms of what can work in terms of integration. But I mean, I think we do need to bear in mind that the actual proposals within MISP are really trying to just break down the barriers across integrating. We still have competition across the EU, and it's not a case that, the proposals are actually trying to consolidate everything. When we're talking about ESMA central supervision, it's to enable entities, if they wish to, on a competitive basis, integrate. And that, I think, sometimes I think people seem quite kind of concerned that we're moving in a direction that everything is just going to be fully consolidated into one place. But from a general kind of industry perspective, the way Euronext operates certainly, I think, is a helpful example of how markets can integrate if they wish to. And that's where we're kind of talking about when we're talking about sort of the Europe single market. I mean, I think we're all kind of stronger working together, integrating together, rather than everyone, working in isolation.
Thank you very much. And yeah, thank you to all of you for a very insightful discussion. So yeah, today's debate has shown that there is a broad agreement on the need for deeper and more competitive European capital markets. But of course, important questions remain on how this should be delivered in practice. Then the discussion has highlighted the need to balance several objectives simultaneously: competitiveness and stability, integration and proportionality, and supervisory convergence and national expertise. And it has also reminded us that market integration is not an end in itself, but ultimately its success will be judged by whether it improves access to capital, supports investment, strengthens competitiveness, and creates opportunities across the European Union as a whole. And yeah, to finish off for Central and Eastern Europe, that question is particularly important, as the success of MISP will depend not only on whether it reduces fragmentation, but also on whether smaller and developing markets are able to participate fully in the benefits of integration. So thank you once again to our speakers and to everyone who joined us today, and yeah, wishing you a great day.
On our behalf also.
Thank you very much. Yeah.
Thank you very much, everyone. Thank you to our audience. I just want to let them know that this webinar was recorded and is going to be published on our website and on YouTube. If they want to share it with their colleagues, we'll also send a link to everyone who registered, just in case they missed it. And keep us on your radar, because we are actively doing this kind of conversations monthly on different topics. So just hear us out. And if you find us interested, just join our newsletter to be informed. Thank you everyone for joining. Much appreciated.
Thank you very much. Have a good afternoon.
Thanks for this initiative. Bye-bye.
Thank you.